Well, welcome back. Appreciate you joining us today in the Principles of Accounting 2 course. We are making excellent progress so far. We have made it all the way to week 6, uh, marching right along to the midterm part of the course, which is coming up next week. So we are almost halfway done with this course, which is phenomenal. Sincerely appreciate your progress in the course so far. You're all doing very, very well. You're also keeping up with the work. So I sincerely do appreciate that. I appreciate all of your efforts. I don't want you to think that it doesn't go unnoticed. I know that this course is not always easy. I try my absolute best to make things understandable, relatable, and I know that sometimes the course could get a little busy, but I just want to let you know that I appreciate everything that you're doing and the progress that you're making in the course so far. So that leads us to where we are today, which is week 6. Today we're going to talk about cost behavior and cost volume profit analysis. Before we jump into the lecture, I do want to call your attention to what is happening and what's going to be due this week. And as I always encourage you to do, is to try to consider and complete your activity, engage and explore activity on Wednesday during our normal class time. You'll notice that this week, just like we had in the very first week of the course, we have another LinkedIn Learning certificate. This one is a really good LinkedIn Learning certificate, and it's based off of managerial accounting. This LinkedIn Learning certificate that you will go through this week is very much directly related to uh, this course. You'll notice that the LinkedIn Learning certificate follows uh, pretty much everything we've covered up in this course so far. We'll start with the managerial accounting, which we talked about back in the second week of the course. Cost and cost volume profit, which we're going to cover today. Cost volume profit analysis, we're going to cover that today as well. Uh, we've learned a little bit already about cost flows when we discussed things like um, continuous process costing and job order costing. Uh, we'll learn a little bit more about variances, and we'll also discuss a little bit things activity-based costing, budgeting, and capital budgeting. So the reason why this LinkedIn Learning certificate for this week is so important is that it's directly related to everything you're learning in this course. So I strongly encourage you to complete this LinkedIn Learning certificate starting on Wednesday. You'll notice that it's relatively lengthy. This entire LinkedIn Learning certificate should take you probably about 2 hours or so to complete. So I would encourage you to again start that early. I would encourage you to start that as early as you can. You can start it today, you can start it tomorrow, but definitely Wednesday during the class time to complete this. And just like you did before, you'll need to make sure that you watch all of the videos, make sure that green check mark is there next to all of the videos. You go in order, don't skip anything, and that when you get to the very end of the conclusion, you'll watch the rest of that, and then it should pop up. So you make sure your pop-ups are enabled. You want to use either Microsoft Edge or Google Chrome. And then once at the very end, it should open up like this. And you'll click on LinkedIn Learning Certificate, and then you'll click Download PDF only. You could also post it to your account if you wish, and that's totally fine. Now, once you've downloaded the PDF, you'll come back to the classroom and you'll upload it just like you did before in this area. And if you run into any technical issues, just reach out to me. I'll be happy to walk you through it. Okay. So let's make sure that we complete that. I'd like you to do that on Wednesday, just to make your work for the week a little bit easier. Okay. But otherwise it's due on Sunday. And then of course we have a quiz related to cost, volume, profit analysis, which is the chapter we're about to jump into. Any questions on that before we start the lecture? We're all good. Okay.
So the Professor, I'm sorry.
Yeah, Oscar, please.
Yeah, so this is gonna be like same as the previous one that we did for the certificate one, right?
Exactly. Yeah,
It's
it's
gonna
just
go like all the slides and then
you got it.
when
It's
we
just
finish, we just gonna download, right?
exactly. It's just like the one that you did for QuickBooks during
Okay,
the first week of the course. Yep.
sounds good. Thanks.
You're very welcome. Thank you. Great. Again, if you run into any technical issues, please feel free to reach out to me, and I'll walk you through that because I don't want you to have that type of issue. Especially if it's something that we can avoid. So, okay. Well, thank you so much for bearing with me as we talked about that. Now let's jump into the lecture. You'll notice that the title of this lecture is called Cost Behavior and Cost Volume Profit Analysis. You might be wondering to yourself, well, what kind of behaviors do we have with cost? Well, one thing I had mentioned before is that accounting and finance is 80% behavioral, and really only about 20% book knowledge. What I mean by that is accounting and finance are driven based off of human behavior, which drives cost in business. And I'm going to talk about that to some extent just to make it a little bit more relatable. And I'll give you some examples and things like that. But this discussion is very analytical. We are going to be analyzing changes in cost. And as a manager, it's really important that you understand how to analyze those costs because you'll need to make decisions for the business. A lot of what we're going to talk about today is related to the sales price of goods and services. The sales price is a very difficult thing to set in business. And the reason why I say that is because you need to understand all of the costs related to that product in order to set the sales price for that product. And we're going to work through this concept called cost volume profit analysis, and that'll help you to understand how prices are set, how sales prices are set. So when we talk about setting sales prices, we also discuss what we call sales volume. Sales volumes are related to the number of units that we expect to sell, right? And so being able to set the pricing is related to how many units we expect to sell. We need to know how many units we need to sell to break even. Break even is a concept that says I've sold enough units in order to cover all of my costs. Once you've done that, you've broken even. You did not make a profit, but you also did not make a loss. We call that breaking even. Okay. So cost volume profit analysis helps us to understand how many units I need to sell to break even. We also use this method to understand how many units I need to sell in order to achieve a certain amount of income. We call this target income or target profit. Okay, the idea here is that if you want to make $100,000 in profit by the end of the year, we need to figure out how many units we need to sell in order to achieve that goal. That's what target income means. We also need to understand how much our income will change if we were to purchase or sell property, plant, and equipment, which, as you know, is investing activities to grow the business. Because with the increase in cost, like a new piece of equipment, we know that our fixed costs will rise, and we need to be able to cover that fixed cost. This one is really important. When there's a change in the sale price, will the sales volume, number of units I expect to sell, go up or down? That's an excellent question every manager should understand. If I reduce my sale price, I would expect that I'll probably sell more units. Why? Because a lower price attracts more buyers. That's economics, right? So I set a lower price, I'll probably sell more. We hope. If I increase my sale price, I might sell less. But with those changes in sales price, what happens to the profit? What happens to the sales amount? Yeah, that's something we need to look at and understand as managers. And then, of course, in business, you know that we don't just sell one product. In most cases, most businesses sell multiple products. We need to understand what happens when there's a change in income based off of a change in the sales mix of those products. Meaning, if I add new products and services to my business to sell, what happens to the change in income? How does it look with multiple products? That's what I'm trying to say. So these are the types of questions we look to answer as managers. There's a couple of things that you learned over the past few weeks when we've been talking about cost. As you know, the cost to make a product involves direct materials, direct labor, and factory overhead. And we know that those costs together equal the total cost of a product. But how do we break out that information even further? We categorize them into what we call fixed costs and variable costs. Fixed costs are costs that do not change regardless of the level of output. Meaning, it doesn't matter if I made 1 unit or 10,000 units, my fixed costs are the same, and I still have to pay them regardless of the number of units I'm making. An example of this, $32,000 paid in monthly rent for a factory. It doesn't matter if the factory's running 24 hours a day or 8 days, 8 hours a day. Doesn't matter. The rent's the same. It doesn't matter if the building is full or empty. Still got to pay the rent. Doesn't matter if I made 0 units or 10,000 units. Still got to pay the rent. And the rent amount doesn't change every month. It stays the same. We call that a fixed cost. If it doesn't change and it stays the same regardless of the level of output, we call it a fixed cost. When it comes to the total amount of fixed costs not changing regardless of the level of output, they don't change, right? However, if we look at fixed costs on a per unit basis, meaning we apply the fixed cost to the number of units we're creating, then we can further analyze our total fixed costs. Here's what I mean by this. I had mentioned that our monthly rent is $32,000. If I produce 200 units, the average rent in terms of a cost per unit is $160 per unit. The way we figure that out is we take the total cost per month, in this case $32,000 a month, divided by 200 units being produced per month. Now, when it comes to manufacturing, we don't always make the same number of units every single month. Sometimes we make more, sometimes we make less. Depends on the demand, depends on the sale price, that kind of thing. So when units of production increase, meaning we're making more units, the fixed cost per unit decreases. So let's say we make 1,000 units instead of the 200 we were making last month. This month we're making 1,000. We take the $32,000 rent per month divided by 1,000 units. That gives us a fixed cost in rent per unit of $32. You see? So the more units I make on a per unit basis, the fixed cost goes down. I'll show you some more examples of that, but that just kind of gives you an idea of fixed costs. So the way to think about this is total fixed cost does not change. $32,000 a month is $32,000 a month, regardless of how many units I'm making. However, if I apply that to a per unit cost, the fixed cost per unit decreases with the more that I make. You see? That's the point we're trying to get at. So that's fixed cost. And of course, that, as I had mentioned, we also consider what we call variable costs. Variable costs change with the level of activity. Okay? Here's what we mean by this. Direct materials is an example of variable cost. Direct labor is an example of variable cost. But we know that overhead can be separated into both fixed and variable costs. Here's an example. Let's say 1 unit of product requires $20 of direct materials. We have a total direct material cost of $200 when we make 10 units, $400 when we make 20 units, etc. Therefore, you can see that the total variable cost increases with the increased amount of production. However, the per unit variable cost stays the same. Because remember, to make the total cost of a unit is direct materials plus direct labor plus a little factory overhead, variable cost factory overhead. That equals a total cost of a unit. Okay? That total cost of a unit stays the same regardless of the level of output. However, the total variable costs increase with an increase in the units of production. They would also decrease with a decrease in production, you see? It's related. So now that you understand fixed costs, now you understand variable costs, here they are together, fixed and variable costs. As we had mentioned, fixed costs, total fixed costs on the top chart here. On the top chart, total fixed costs remains the same regardless of the level of output. And we know that total variable costs increase with the level of output. Fixed costs plus variable costs equal total cost. And you'll notice that the total cost line on the top chart, at 0, it equals the fixed cost amount. As the number of units of production increase, so does the total cost, because it's fixed plus variable cost per unit production. That equals your total cost. Now we look at the graph on the bottom. As I had mentioned, the graph on the bottom looks at it on a cost per unit basis. You'll notice that the fixed costs per unit decrease with the more units of production I have. And the variable cost per unit, that's direct materials plus direct labor plus variable factory overhead, equal the total cost per unit. Total cost per unit does not change regardless of the level of output. However, my fixed costs on a per unit basis decrease as the output increases. You see? Call this economies of scale. You may have heard that term in your macro or micro economics course. And the idea here is that the total cost per unit decreases with the higher levels of output. So you learned about fixed costs. You learned about variable costs. Now you know how they work together. There's a third type of cost we need to talk about, and we call it mixed costs. A mixed cost is a combination of both fixed and variable cost components. Not together, that would be total cost, but fixed and variable cost components. Here's what I mean by this, and I'm going to give you a real life example. At UDC, we lease our copying machines, the big industrial size photocopiers. I know it's ancient technology to some of you, but we have this thing called a copying machine. It makes copies of paper, right? That's what it does. So we use this machine when we have in-person classes and the professor wants to give a handout to the students. So we go to the copy machine, we log into it, and we make our copies, okay? The university made an agreement with, we'll say, Xerox for these copying machines, okay? And the agreement goes like this. For every year that you lease the machine from us, it costs $100,000 to lease the machine per year. Okay? And that lease of the copying machine goes up to, we'll say, 500,000 pages of copying material. However, once you go over the 500,000 page limit, it's 1 cent per page. You see, there's the fixed and variable cost components. The fixed cost component is the $100,000 per year lease agreement, up to 500,000 pages. The variable cost component is the 1 cent per page after the 500,000 page limit. You see, that's what we call a mixed cost. We have a fixed cost component and a variable cost component. That's my real life example. So as you can see, the mixed cost, they start at a certain point. They start at a certain point. It's after the fixed cost, and then it goes up, right? So this graph represents. So that's mixed cost. Some of you are probably familiar with mixed cost in your personal lives, but some of you are probably more familiar with stepwise costs. I like stepwise costs. It's an interesting pricing model. Here's what I mean by this. A stepwise cost looks like a staircase, right? The cost is fixed until you reach a certain amount of production, then it goes up, and then it's fixed again until you reach the next tier of amount, and then it goes up. You see? This is a very commonly used model, and it's used in ways you probably don't recognize. Here's your real life example. Your cell phone. A lot of you have a cell phone plan. You have a cell phone plan with your provider, right? Now let's say you're like me and you have AT&T. And they say in my contract, all right, Dr. B, you have unlimited text and talk and 3 gigabytes of data. Okay, great. For me, that's more than enough. So I would be here at this lower step. Yeah, 3 gigabytes of data. They say once you reach the 3 gigabytes of data, meaning I've used 3 gigabytes in a month, we will increase your cost by $10 for the next gigabyte. Okay? If I use that gigabyte of data, then it goes up again by another $10 for the next gigabyte. You see? We call that a stepwise cost. So you might be familiar with that for something like a cell phone plan. Okay, just give you an idea. Here are some examples for each one. Fixed costs are costs that do not change regardless of the level of output. That would include things like rent, property taxes, insurance, office salaries like managers, supervisor salaries, and depreciation expense. For variable costs, these are costs that do change with the level of output, and they also include the variable cost components of manufacturing a product. This would include things like direct labor, direct materials, packaging, shipping, indirect materials. Then, of course, we have mixed costs. Examples of this would be salesperson salary plus commission, natural gas. It starts at a certain, same with electricity. It starts at a certain megawatt per hour. There's a fixed cost component. We call that the service. And then after that, it's done by megawatt per hour. Maintenance, if there's a maintenance agreement and then they send somebody out for the repair part's the variable cost. A water bill, same concept, starts with a service and then the variable part is per gallon, right? So those are examples of mixed costs. And then with the stepwise cost, examples of this would be adding or dropping shift of workers, adding or dropping a production line, a warehouse, sales region, cell phone plan. You see, so those are just some examples of uses of these 4 cost models. Okay. Any questions on those before we jump into some calculations on these types of costs? We're good? Okay. All right. There are a couple of ways that as managers, we look at this data to those costs to understand them, to analyze them, to be able to understand the behavior of those costs. And so there's a couple of ways we measure cost behavior. One of those is through what we call a scatter diagram. Just as the name implies, it's points of data, and then there's a line, call it a regression line. We use what's called a high-low method. High points of units produced, low points of units produced, high points of total cost, low points of total cost throughout the year. High-low method. And then we also use regression analysis. Regression analysis is a statistical value model. And this statistical value model of regression analysis, I'm not going to have you doing any graphing in this course. I just want you to know and understand what regression analysis model looks like, okay, and how it works. So those are the 3 we're going to talk about. So here we have some data. First, I'm going to show you the scatter diagram, then I'll show you high-low method, and then regression analysis. Here we have some data. We have all 12 months of the year. We also have an estimate of the number of units we expect to produce in each month. And a lot of times that's based off of our previous sales. We also have an estimate budget of our total costs for each month. Okay. Now, in just looking at this graph of data, we can identify a couple of key pieces of information. For example, we have high number of units being produced in certain months, low units in certain months, low cost in certain months, high cost in certain months. So by looking at this data, we can think about, high points and low points. Now, using a scatter diagram, I'm going to plot each month on a graph, or I'm sorry, a chart. And on this chart, you'll be able to see where each month falls as they relate to each other. Based off of number of units produced on the x-axis, and on the y-axis we'll have our total cost. Now, you already know, hopefully you know, you can do this in Excel pretty easily. You just drop this data in, highlight it, and tell it to make a graph or chart, and it'll do it, right? So I want to show you what this looks like. So here we have this scatter diagram. It's a graph of the number of units being produced and its respective cost data. That's what each point on the graph shows us. For example, in the month of March, it shows that we've produced 25,000 units from the x-axis, and on the y-axis, a cost of $25,000. And we also see that our fixed cost component starts at 17,000. Okay. So you'll notice that each month is represented by one of these lovely green dots on this graph. Yeah. And you'll notice this line, orange line, whatever you want to call it. It runs in between these points of data. We call this an estimated line of cost behavior. It's a regression line. Okay. It helps us to identify the correlation where it is best fit. Yeah. Closest to the points of data. It also helps us to estimate where costs are heading. Yeah, that's what this line does. So you'll notice March a little further away from the other months with respect to where it is on this graph. That tells us that March is what we call an outlier, which means it's not closely correlated with the other months. So that's the type of information you can visually see and understand from using a scatter diagram for costs and number of units being produced. So now you've seen the scatter diagram. The other method I wanted to talk about is what we call the high-low method. We do this high-low method because we want to identify at points where we have highest and lowest volume and highest and lowest cost. We do this process in 3 steps. The first step is to identify the highest and lowest volume, which may not always be related to the highest and lowest costs. So who can tell me in the classroom today, who can tell me which month do I have the highest units produced? Which month do we have the highest units produced? Looking at the data.
Like the obvious month, Professor?
Yeah,
I think that's what you said before that. Look like November.
November. I would agree with you. I think November is definitely the highest units produced. That's what it looks like, 67,500. Looks like the highest number out of these 12 months. So yes, I agree.
What did you say before you asked that? I'm sorry, Professor.
No, that's fine. I wanted, looking at step 1, we identify the highest and lowest volumes. and that the costs are not always aligned with those.
Okay.
So we see that November, as you had said, is the highest units produced. What about the lowest? What month is the lowest? November for the highest.
June. Is it
Could be
June?
July.
It looks like June. It looks
Okay.
like June for we're talking about the lowest units produced. So 17,500 in June looks like to me the lowest, right? Based off of the 12 months. Yeah. So we have November for the high, June for the low. What about cost? Total cost. What's the highest total cost on this in this information? Highest total cost.
November? Or am I
So
reading?
yeah, it looks like November. It looks like
November?
November. Yeah, 31,000. What about the lowest total cost? What month does that occur in?
June.
It is June, isn't it? So in this case, the number of units produced do correlate with
So
the
you're saying, Professor, if November has the total, I mean the highest units produced, the highest total cost could have been July, is what you're saying.
correct. Yeah, that's what
Okay.
I'm trying to say. Is that the total costs do not always relate with the total units being produced. Yeah, absolutely right. Yeah, good. This is good exercise. Okay, so we got November being the high, and we got June being the low. So we've got step
So,
one.
question.
Go ahead, Oscar.
So what does that mean? Like November, the highest unit produced, but the total cost is only 31,000.
Mm-hmm.
This for June is 17,000 and the total cost is 18,000. What does that mean? It's just like a 1 grand difference between June and
Mm-hmm.
from the
Yeah,
total unit produced and total cost from November, total cost is like more than double and it's only 31,000 costs.
exactly.
I
Yeah,
mean,
you're on the right track with this thought process, Oscar, because we're actually going to cover these in the next two steps. But the reason why we explore the high-low method, we find the high point, we find the low point. What that does is it helps us to figure out more or less the average on a per unit basis. Okay, so that's why we look at things like high, low. It helps us to figure out the average. And so, Oscar, the second step of this process is we're going to compute the slope of the line. Okay, and the way we're going to do that, and I'm going to show you here in the next slide, is by understanding the variable cost per unit based on the high-low points of data. Okay, so that's the second step, is to compute the slope. All right, we take the variable cost per unit, we find that using the high and low points of this data. Ultimately, what it's doing is it's helping us to find the average. The third step in this process is we're going to compute the total fixed costs by looking at the total variable costs at either the high or low levels, and then subtract from the amount of the total cost at that volume. So it's a three-step process. The first step, we figured out the high point is in November, 67,500 units at a total cost of 31,000. And we found the low point, June, 17,500 units at a total cost of 18,500. So now that we have those two, we want to then go on to the next two steps. So first step, we found the high, we found the low. Okay. Second step, we want to compute the variable cost per unit. And how do we do that? We need to separate the high and low. So high volume, cost at the high volume, in this case 31,000, minus the cost at the low volume, 18,500. gets us to 12,500. Then we subtract the high from the low in terms of the number of units. 67,500 units at the high minus at the low 17,500 gets me to 50,000 units. We take 12,500 divided by the 50,000 units to get a variable cost per unit of 25 cents per unit. Okay, so that's step 2, is find the variable cost per unit using this high-low method. Now that we know the variable cost per unit, we can figure out the fixed costs. Now I can hear you saying, well, how are you going to do that, right? So here's how it works. The fixed cost is unknown, so we got to figure out what that is. We know what the variable cost is. It's 25 cents per unit. We take that 25 cents per unit and we multiply that at both the high level and the low level. We do it separately, yeah. So 25 cents per unit times 67,500 at the high, that gets me $16,875. We also understand that our total cost at the high is 31,000. So 31,000 equals X plus 16,875. Now, as you recall from algebra, I guess, is that we take that total cost and we subtract the variable cost. Take the total cost minus the total variable cost in order to find the missing value, which in this case is fixed cost. So remember, anytime you need to solve for X, it's just a matter of taking that total cost and subtracting it. So we got total cost minus, another way to write the equation, total cost minus variable cost equals fixed cost. You see? So that's a way of finding the missing variable. Finding the missing component, I should say. So we do that for the high side, and we do that for the low side. On the low side, total cost was 18,500. Variable cost is still 25 cents per unit. Multiply that by the low production of 17,500 units. Gets us a variable cost per unit. Total variable cost 4,375. You take your total cost minus your variable cost equals your fixed cost. Okay, you'll notice that they balance out at the high and the low at 14,125. Okay, you want them to equal. That's the point that I'm getting at. So to find the total cost, it's the fixed cost, 14,125, plus 25 cents per unit produced. So, yeah, that's how you use the high-low method. It comes in handy when you got 12 months of data to analyze and figure out what the fixed costs should be. Okay, and then regression. Regression analysis is a little bit complex, and if you've taken statistics, you may have come across a term called the least squares regression. It's also known as regression analysis. It's a statistical model for identifying cost behavior. Okay, in Excel, there are two functions for this. There's what we call the intercept function and the slope function. It helps you to graph the best fit line for the cost data. It should be pretty darn similar to graphing the scatter plot, you see. The idea here is that we are determining total fixed cost and total variable cost per unit using that data. So we're not going to go any deeper than that on regression analysis. I just wanted you to understand what it is and how it works. Here we see a comparison of the high-low method compared to regression analysis. The reason why this comparison is important is because you can see that based off of the same data, using two different methods, we can see that fixed costs are different slightly, and variable costs are also slightly different. So that's why it's important to apply a method that is most accurate. And in most cases, using regression analysis is going to be more accurate than the high-low method. But of course, in most cases, we always go with whatever's quickest and easiest, right, for doing any type of estimates. So that was analyzing costs through cost behavior. Now I want to talk to you about a really important concept called cost volume profit analysis. We did a little bit of that with cost behavior, but I want you to understand from the perspective of understanding how businesses use their cost structure, how they analyze it. And in that, the first thing I want to talk about is this concept called margin. It's more specifically contribution margin. Contribution margin essentially tells us, in a very easy to understand general sense, based off of our sales price, based off of our sales price, how many dollars am I getting a profit, right? So the way we compute this is we take our sales price per unit minus our variable cost per unit. As you know, variable cost per unit, that's direct materials, direct labor, and variable factory overhead. Here we have an example. We have a company that sells footballs at $100 per football. That's our sale price. I know it seems a little high. We have a variable cost of making the football of $70. Okay, it's good leather, it's good stitching, the employees are great, and I'm covering my variable cost. $70 to make a football. That gives me a contribution margin per unit of $30. Sales price minus variable cost per unit equals contribution margin per unit. Now that I know that part, I can also compute, now that I know what the contribution margin per unit is, I can also compute what we call the contribution margin ratio. This shows us percentage of each sales dollar of profit, basically, after deducting the variable cost. And the way to calculate that is we take the contribution margin per unit divided by the sales price per unit. And so in our example, we take the $30 contribution margin per unit divided by $100 sale price per unit, giving us $30 which, by the way, is a very good contribution margin ratio, my opinion. That means that for every dollar of sales that we make, we're going to get 30 cents of that to cover our fixed costs and ultimately produce an income. So that's contribution margin. So important to know that, okay? If you're in business, looking to go into business or whatever the case is, understanding your contribution margin on a per unit basis is going to be critical to making sure that your sales price covers both your fixed and variable costs. You see? So now that you know that contribution margin concept, I want to look at this concept called break even. As I had mentioned, breaking even means that we are not making a loss and we're not making a profit. It means that our net income would be zero. That's breaking even. It means I've sold enough units to cover all of my costs. I broke even. Okay? Very simple concept. There are 3 different methods to calculate the break-even point. The first is called the formula method, where we use the break-even formula. And there's a few of those I'm going to show you in units and in sales. There's the contribution margin income statement. I'm going to show you how to calculate contribution margin on an income statement. And we also have the cost volume profit chart. Just as the name implies, I'll show you on points of a chart. We're going to use the same football manufacturer example that we did before. Remember, our sales price is $100 per unit. Our variable cost is $70 per unit. The company has a total fixed cost of $24,000 per month. Okay, let's take a look. The first method, of course, is the formula method. The break-even formula is fixed costs divided by contribution margin. To break it out further, the break-even point per unit is fixed costs divided by contribution margin per unit. We know that our sales price is $100. Our variable costs are $70. That means our contribution margin per unit is $30. Our fixed costs are $24,000 per month. Contribution margin $30 per unit. 24,000 divided by 30 is 800 units. That means I need to sell 800 footballs per month in order to break even. How many of that, how do I figure it out in terms of sales dollars? How many dollars of revenue do I need in order to break even? The way we figure that out is we take our fixed cost, 24,000, divided by our contribution margin ratio. Remember, the contribution margin ratio is a contribution margin per unit, $30 in this example, divided by the sale price, $100. 30 divided by 100 is 30%, or 0.30. So 24,000 divided by 0.30 is $80,000 in sales that I need to make in order to break even. So now you understand the break-even formula in both terms of the number of units to sell and how much revenue to make in order to break even. The second method is called the contribution margin income statement method. As you recall, the income statement has sales minus cost of goods sold equals gross profit. Then you got all your expenses listed out equals operating income minus taxes and other equals net income, right? That's the typical income statement of a business. In order to understand the contribution margin for the income statement, we do it like this. We got sales minus variable costs. That's variable cost total. Yep. Equals contribution margin minus fixed costs equals income. Okay. In terms of break even, I had mentioned that breaking even means we did not make a profit or a loss. The net income should be zero. So in order to figure that out, we take sales. We need to sell 800 units to break even, remember? Per month. At $100 each, that's $80,000 in sales. Minus our variable costs. The number of units we need to sell, 800, times $70 a piece. You see? Variable costs are $70, remember? So number of units times variable cost per unit equals 56,000 in this example. 80,000 minus 56,000 equals 24,000. Also known as number of units times contribution margin. My fixed costs are also 24,000. So 24,000 minus fixed cost 24,000 equals zero, right? So that shows you the contribution margin based off the income statement method to find the point of break even. If it's not zero, that means it's not right. We're missing something. And then, of course, the third method is the cost volume profit chart. The point of break even is where you did not make a profit and you did not make a loss. You broke even. And graphically, we can see that it's 800 units I need to sell or $80,000 of revenue. That's my point of break even. Just kind of shows you graphically. Yeah. Now, what if? And I could hear you. Well, Dr. B, business is not always straightforward like that. We don't always sell the same number of units every single month. Or what if my sales price changes? Or what if I sold more, sold less, or whatever, right? That's business. It's never the same every single month. You know that. So oftentimes what we do is we try to figure out estimates. What's likely to happen? Right? Give me an idea. I mean, you said we're not going to sell 800. What if we? You said we're going to sell 800. What if we sell more than that? What if we sell less than that? So we like to think about estimates in those terms. So let's say, we planned on selling each football at $100. What if we sell it at 96? And we thought our variable costs were going to be 70 per unit, but we're paying our employees a little bit more. So it's 72. Okay. So let's look at this possibility. Instead of 100, we sell for 96. Instead of variable cost 70, it's 72. Sales price minus variable cost equals contribution margin. A pessimistic contribution margin would be $24 per unit. And let's also say my fixed costs might be higher than expected. They're 27,000 instead of 24 because my insurance went up or might go up. So 27,000 instead of 24. So based off of that $27,000 fixed cost divided by contribution margin per unit of 24 means I would have to sell 1,125 footballs per month instead of 800. But you can see how this process can be used if you're selling more or less, or the prices are different, or fixed cost is different. You could run out different scenarios. That's what I'm trying to tell you. The formula doesn't change. The process is the same. So all you're doing is you're plugging in different values based off of those changes. That's why we call it cost, volume, profit analysis. The costs, the volumes, and the profits change. You see? So that's that part. That's changes in estimates. Now, there's a couple of other things you need to know because when we look at cost, volume, profit analysis, we've calculated our contribution margins or contribution margin ratios. We have an idea of how many units we need to sell, how many sales dollars we need to earn in order to break even. In business, we want to do more than just break even. We didn't go into business to break even. We went in business to make a profit, right? And it's also important to understand that I need a little bit of safety in business. I can't just break even. I need a little bit more than that to feel comfortable, to feel safe in business. And we call this a margin of safety. Right? It's the idea that we got a little bit more before we start making a loss. Right? What's my margin of safety? Where's management going to feel comfortable? And understanding that there's variability when it comes to sales. We call this a margin of safety. It's the expected sales minus the break even in sales divided by expected sales. It's a percentage, yeah? So sales, we expected to sell $100,000 per month. Minus the break even of $80,000. Divided by expected sales of $100,000 gives me a margin of safety of 25%. Okay. We can also express this in terms of dollars or percentage. Just kind of shows you what it looks like. That's margin of safety. We can also compute income from the expected sales and costs. I expect to sell $1,500 in the month of January. 1,500 units in the month of January at $100 each. Variable cost is $70 a piece. Contribution margin is $30 a piece. So based off of these expected sales, I can figure out what my expected income should be. So 1,500 units at $100 a piece, that's $150,000 in sales, minus variable cost of $105, equals contribution margin of $45, minus our fixed cost of $24, equals an income of $21. See, the idea here is that you can see that you use this model to illustrate a change in the amount of sales and what that does to the total income. Now, I mentioned that with target income, this is the expectation of how much profit or income I want to earn. I want to earn an income of $12,000 per month. How do I do that? A way to figure out this process, I'm sorry, that should be a plus, not a minus. We take our fixed costs plus target income. Fixed cost plus target income. Fixed costs are 24,000 plus 12,000 target income. Divided by a contribution margin ratio, 30%, equals $120,000 of sales I need to produce per month in order to generate a $12,000 income per month. That's how target income works. You could also calculate this in terms of the number of units. $24,000 fixed cost plus $12,000 target income divided by contribution margin percentage of 30% means I need to sell 1,200 units in order to generate $12,000 of target income. And then, of course, you can also figure this out by working backwards on your income statement. My target income is 12,000. I know that my fixed costs are 24. Target income of 12,000 plus $24,000 of fixed costs gives me a contribution margin of 36,000. How did I get that contribution margin of 36? Well, I added fixed cost plus the target income. If my contribution margin is going to be 36, I know that I'm going to need to sell $120,000 because I have variable costs, $70 per unit. You see? Sometimes it's a matter of working backwards. You're building it in. Understanding your break-even point in business is so important. Not just in order to figure out how much I need to sell to generate a profit or income. Oftentimes we use cost, volume, profit analysis to also get an idea of how much I need to sell because in the future I want to purchase some new property, plant, and equipment to grow the business, right? So ways we would do that is by creating different models of what could happen in order for me to generate enough revenue to set aside for purchasing some new property, plant, and equipment. Call those capital expenditures, right? And we will also look at things like how many units I need to sell or how many dollars I need to sell to get some new advertising, etc. So we revise. Okay, here we have a couple of examples. Revised break-even point in terms of dollars in order for us to buy a new piece of machinery. Let's say we're looking to buy a new piece of machinery. Our fixed costs go from $24,000 to $30,000 per month because we're buying a new piece of machinery or want to. Based off of that, I know that I need to revise, or what will happen is I'm going to need a revised contribution margin ratio. The new piece of machinery actually reduces my fixed costs. I'm able to produce more units. So my variable costs end up dropping $70 down to $60, which means my contribution margin goes up. Contribution margin ratio goes up. You see, all this to say that in business, when things change, we need to revise our estimates in order to make sure that we're still breaking even or doing better. And one of the last concepts I want to talk about, especially when it comes to breaking even, is this thing called the sales mix. I had mentioned that businesses sell more than one product, more than one type of product. Okay, let's say we don't only sell footballs, we also sell basketballs and baseballs and whatever, right? Let's say we sell both footballs and basketballs. Well, how do you figure out break even with two different products? I got two different variable costs, I got two different contribution margins. We calculate this thing called the sales mix. The sales mix represents the portion of sales volume for each product that we sell. Okay. So I sell footballs and I sell basketballs. I primarily sell footballs. 60% of my business is from footballs. That means that the other 40% comes from basketballs. We call that a sales mix ratio of 6-4. Let me walk through the example with you. When we sell different products, we need to calculate the break even. And we do that through what we call the weighted average contribution margin per unit. The weighted average contribution margin per unit tells us what the average contribution margin is on a per unit basis. So that way I can go and apply that to my sales mix. So here we have some information. Footballs, we sell for $100 per unit, variable cost is $70, contribution margin is 30%. My total sales represent 60% of footballs, which means the remaining balance of 40% is in basketballs. It's got to equal 100, right? My sales price for basketballs is $120 per basketball. Variable cost is $85, giving me a contribution margin of $35 per unit. To find the weighted average of contribution margin per unit, we take the contribution margin per unit of each product and we multiply that by the sales mix percentage of each product. And of course, I add the two products together to get, in this example, $32 per unit. That's my average. Makes sense. So in understanding that, I can find my break even in terms of units for the whole company, selling these two different products. And to find the break even in units, we take the fixed costs divided by the weighted average contribution margin per unit. $48,000 per month of fixed costs divided by weighted average contribution margin per unit of $32 means I need to sell 1,500 units combined, yeah, per month to break even. That's what it looks like. In order to figure out how many units of each I need to sell, you take the 1,500 units times the sales mix percentage. That's how you find how many units of each product you need to sell in order to break even. Yep. So in cost volume profit analysis, we classify our costs as either being fixed or variable. We run what we call linear costs through a relevant range. We talked about this. And the units produced are sold in inventory constant. The sales mix is constant. These are all of our assumptions. Okay, in order to help us to estimate things in the future. Yeah. There's another concept you should know, especially when we're talking about this changes in sales, and we call that a degree of operating leverage. What this does is it helps us to measure the effects of changes on different levels of sales and the impact on the income. And the way we do that is we take the contribution margin divided by income. Yeah, pretty straightforward. And using our example, contribution margin of 36,000, sales minus variable costs equals contribution margin, divided by our income. Here we have an example of a degree of operating leverage of 3, which I think is pretty good. And of course, to find the change in income based off of the degree of operating leverage, we take the degree of operating leverage, in this case 3, times a change in sales percentage. How do we find the change in sales percentage, you might be asking? The change in sales percentage comes from the current year minus the old year, or previous year. Current month minus the previous month. You can also look at this in terms of ranges. Where we currently are, and what happens if there's an increase in sales by 10% or a decrease in sales by 10%. That shows you the changes based off the degree of operating leverage. And of course, it really is best done using Excel, in my opinion. And here we have an example of this. Remember, Excel is a very powerful tool, as you know, and you can figure it out graphically from there as well. So, and just to also kind of recap, all of those concepts, we can apply those in a lot of different ways, but it's just a matter of understanding that as your sales volume changes, there's that expectation of your fixed costs remain the same, your variable costs will could possibly change. But remember, the total cost changes with the level of output. We're almost done. The contribution margin on an income statement basis, we talked about that. We understand that the variable costs change with the level of output. And you know that the variable costs are based off direct materials, direct labor, and variable factory overhead. And that fixed overhead costs are excluded from product costs because they're fixed. And one way that we look at the separation of variable cost from fixed cost is through what we call absorption costing. Absorption costing includes the cost of direct materials, direct labor, and all of overhead, both fixed and variable. It's absorbed. Yeah. So absorption cost means. And here we can see a difference between the two. Remember, in absorption costing, fixed overhead is absorbed with variable overhead. Whereas variable costing, it's not included, it's separated. And so ultimately, with that type of change, it's going to change your reporting. Yeah, it's going to have an impact on your reporting. And here we see an example of the difference between absorption costing and variable costing. You'll notice the impact on income. With absorption costing, because we're absorbing both fixed and variable overhead into your total cost of goods sold, it adds to the income because it's not found under fixed expenses. You see? Personally, for me, I prefer them separated out under variable. I prefer the variable costing method because having a lower income, while it doesn't sound that glamorous, it helps you when it comes to taxes. You know what I mean? So the formula for income under absorption costing is income under variable costing plus fixed overhead and ending inventory minus fixed overhead cost and beginning inventory. And that will give you the income under absorption costing. My friends, that's the end of our discussion today on cost, volume, profit analysis. For this week, as a reminder, you have your LinkedIn Learning certificate, which I'd like you to complete by Wednesday during class time. Otherwise, it's definitely due on Sunday, yeah? But I'd like you to use the class time on Wednesday to do it. And you also have the Chapter 21 quiz related to our discussion on cost, volume, profit analysis. Are there any comments, questions, or concerns? We're good? Okay. Awesome. Thank you, Shanti.
So great, Professor.
Okay, thank you, Oscar. Great. Okay, if you ever need anything in the meantime, you can email me, call me, set up office hours. I'm always here for you, and I'm here for your success. I hope you feel that.
Thanks, Professor.
My pleasure. Thank you all so much for your time today.
Professor,
Yes.
are we meeting next Wednesday?
Next Wednesday? Oh, that's right, because Monday's is Monday a holiday this year? It is.
Yes, sir.
It's a President Day.
I'm going to post. Well, so we're not going to meet next week, and the reason why that is that midterm exam. You're going to take your midterm exam next week. I am going to post a video for a review for the midterm exam. Okay, and you'll have the opportunity to ask me questions about that as well.
So we don't meet at all.
Not next week, no, because you'll have the
Okay.
midterm exam. Yeah,
So see you on the 26th.
correct. Yep. Awesome. Great question.
Okay.
Is the
Okay.
midterm will be available or
Yeah.
you're
Oh
gonna
yeah. It's open now. It's been open the whole time. So if you want to take a look at it, you're more than welcome to. You can start it, stop it, come back to it. But yeah, it's open now if you want to take an early look.
Okay.
Any attempts on the midterm, Professor?
Just one. One attempt
Okay.
on the midterm, one attempt on the final.
Okay.
Yeah.
All right. Good to know. Thanks.
Okay, you're welcome.
All
Thank
right,
you.
Professor.
Have
Thank
a
you
good
so
one.
much. Appreciate all of you. Good night. Good night.
Night.
Thank you so much. Take care. Ciao for now.